Good day to Dr. Alif. My name is ELEAZAR and today I'll be presenting a comprehensive financial statement analysis and ratio interpretation of SENGHENG New Retail BERHAD. This presentation will cover three main sections, which is introduction, findings and analysis, and conclusion. Let's begin with introduction. SENGHENG New Retail BERHAD was founded in 1989 in Pandan Jaya, Kuala Lumpur by Lim King Heng and his brothers. It began as a small electronics shop and has grown into Malaysia's largest consumer electronics retailer with more than 125 stores nationwide. The company is built on three key values: quality, peace of mind, and convenience, offering trusted products, trained staff, and a wide range of electronics. Its main customers include individuals, households, and businesses such as offices and the hospitality sector. Here, we have the key people behind SENGHENG. Lim King Heng as Executive Chairman, Lim Kim Chieng as President and Executive Director, and Lim Kim Yew as Non-Independent Non-Executive Director. Next, findings and analysis. Let's begin with profitability. SENGHENG's return on asset declined from 9% in 2021 to 7% in 2022 and further to 3% in 2023. Similarly, the return on equity also fell from 28% in 2021 to just 5% in 2023. This downward trend indicates a reduced ability to generate returns from both assets and shareholders' equity. The decline may be due to rising operating costs, decreased consumer spending, or increased market competition. Next, the net profit margin dropped from 4.52% in 2021 to 3.87% in 2022 and then to just 1.90% in 2023. In contrast, the gross profit margin remained relatively stable, hovering around 21% across all 3 years. This tells us that while SENGHENG maintained its product markup, it faced rising internal costs like administration, operations, or interest payment. Moving on to liquidity, which measures the company's ability to meet short-term obligations, the current ratio fell from 2.90 in 2021 to 2.70 in 2022 and further to 2.10 in 2023, while the quick ratio, which excludes inventory, also dropped from 1.45 in 2022 to 0.99 in 2023. This decline means the company's short-term financial cushion is shrinking, and it's increasingly relying on inventory to meet obligations. From a solvency perspective, SENGHENG showed strong improvement in its financial structure, where the debt-to-equity ratio decreased from a high of 2.01 in 2021 to 0.66 in 2023, meaning the company has significantly reduced its reliance on debt and strengthened its equity base, while the interest coverage ratio, which indicates how easily a company can pay interest on its debt, fell sharply from 18.81 in 2022 to just 8.13 in 2023. SENGHENG operational efficiency has also declined over the 3 years. The asset turnover ratio decreased from 2.05 in 2021 to 1.46 in 2023, showing that assets are being used less effectively to generate sales. And the inventory turnover ratio fell from 4.88 to 3.82, suggesting slower movement of goods. And receivable turnover has also dropped from 16.98 in 2022 to 11.51 in 2023, meaning the company is collecting payments from customers more slowly. Let's take a look at the last part, which is conclusion. This part will focus on research and a strength assessment of SENGHENG as well as the investment decision. Let's start with strengths. The company maintains strong liquidity with its current ratio consistently above 2.0 over the 3-year period. This shows that SENGHENG has enough current assets to comfortably cover its short-term liabilities. Second, there's been a clear improvement in solvency. The debt-to-equity ratio has dropped significantly from 2.01 in 2021 to 0.66 in 2023. This indicates that the company has reduced its reliance on debt, improving financial stability and lowering its risk exposure during uncertain economic conditions. However, there are also some warning signs. Profitability has declined over the years. Both return on equity and return on assets have dropped sharply, meaning the company is generating lower returns for investors and using its assets less efficiently. The net profit margin has also decreased, showing that SENGHENG is earning less profit from its sales. In terms of operational efficiency, key ratios like asset turnover, inventory turnover, and receivable turnover have all gone down. This points to slower product movement and delayed cash collection, both of which can impact the company's day-to-day performance. Lastly, the investment decision. SENGHENG shows strong financial stability with a healthy current ratio and reduced debt levels, both positive signs for investors. However, declining profitability and weaker efficiency raise concerns about future growth and cash flow. Given this mix of strengths and risks, the best decision for now is to hold the stock and wait for signs of operational improvement before making new investment move. That's all from me. Thank you for listening.